Hey everyone, today I'm going to go over the types of closing journal entries that you would typically see in an introductory financial accounting course. Um, my textbook that I'm currently using is the Corporate Financial Accounting. It's the 16th edition by Warren, put out by Cengage. So if you have a different textbook, your accounts might be a little bit different, especially if you're not doing corporate financial accounting. If you're currently in like a sole proprietorship, your account title will be a little bit different for your equity account, but the concepts are the same. So you should be able to translate that really well to your particular course that you are taking. So let's go ahead and go through this problem that I've set up here. So it says after the accounts have been adjusted at December 31st, the end of the year, the following balances were taken from the ledger of Meyer Corp. So it lists our balances that we have right now. So your financial statements have prepared and now you're ready to close out your accounts so that your account balances are correct going into next year. So if you remember correctly, if you've covered the concepts of the closing journal entries chapter, you have what are called temporary accounts and permanent accounts. So your income statement accounts are your temporary accounts, along with the dividends account. So those ones we need to close out. So basically we need to zero them out so that going into the next year, they have a zero balance and you've transferred all of those account balances over to your permanent accounts. So your permanent accounts are your balance sheet accounts. So the reason why we do this is so that we can have comparability from year to year. So if you remember on your income statement, that is where you show your net income. So you want to know what your net income is year to year. If you haven't closed out those accounts, you could be showing revenues and expenses that you incurred last year. So if I want to compare, say 2021, 2022, and 2023 together, if I hadn't zeroed those accounts out, those revenues and expenses would be muddled together and I wouldn't know how I did from one year to the next. So you want to know if your business is growing over time. So that's the reasoning why we close out our temporary accounts every year and move those balances into the permanent accounts so that we have comparability from year to year. So let's go ahead and go through this particular problem. So we want to journalize the two entries required to close out these particular accounts. So to close out an account, you want to zero it out. So what that means is a revenue account, like our fees earned account, has a typical credit balance because that's the positive side of that account. So to close it out, I would debit that for the full amount just to make sure that account zeroes out. So our first closing entry is typically to close out your revenues and expenses. So I want to go through and close out these particular accounts. So the date that we're doing this is as of the end of the particular calendar year or fiscal year, depending on which type of year the company uses. So they are using the calendar year, so they're going to close out their accounts at the end of the year. All right, so put in the date. I want to close out my fees earned first because it has a credit balance and our debits need to go first. So to close out a credit account, we're going to debit it. So we're going to go ahead and debit fees earned for the full amount. So it right now has a balance of 900,000 and I need to make that zero going into next year. So I'm going to debit it for the full 900,000. Oop, I did 90,000, of course. All right. So I closed out my revenue. Now I want to close out my expense accounts. Expense accounts carry a normal debit balance. So to close them out, I'm going to credit every single individual expense account. So I need to indent my expense accounts because I'm crediting them, and to show a credit on the general journal, you indent it. So I'm going to space in 3. So wages expense, I'm going to close it out for the full amount of 600,000. I'm going to keep going down the line. So I have rent expense. Oops, I need to indent it. I'm going to close it out for the full amount of rent expense of 110,000. Continuing on down, supplies expense. Close it out for the full amount of the 21,600. And then finally, the last expense is my miscellaneous expense. And I'm going to close it out for the full 12,000. All right, so I'm not done here because if you remember your rules of your debits and credits, I need at least one debit, at least one credit different accounts, and they need to balance. Well, right now, the one thing that is not occurring here, I have at least one debit, at least one credit. They are different accounts, so that has been satisfied, but they do not balance. And the reason why they don't balance is because that's your net income number. So you show your if you remember on your income statement, it shows as revenue minus expenses equals net income. So our revenues were 900,000, our expenses are 600, 110, 21.6, and 12. So that amount gets closed out and moved into retained earnings. So all we're doing is moving these balances into retained earnings so it rolls over to next year so that we can start keeping track of our revenues and expenses individually. But right now, just the amount of income that we're earning will get moved into retained earnings. So we do have an income, so we're going to credit retained earnings, because if you remember correctly, retained earnings is an equity account. To increase an equity account, you credit it. So we do have a positive balance. If you had a net loss, you would actually have to debit your retained earnings because you would need to decrease that. So your retained earnings are essentially just what it says. It's the earnings that are retained every year and rolled over to the next year. It is a permanent account. So we're going to move the balance into retained earnings. So I need to debit it. So I'm going to, or credit it, sorry. I'm trying to confuse you there. I need to credit it. Retained earnings. And we're going to credit for the net income number. So our net income equals our revenue minus our expenses. So I'm going to go ahead and sum up my expenses. So our net income number is $156,400 for the year. And you can see that gets moved into retained earnings by increasing it, and that will roll into next year. So it's those earnings you're retaining every single year. All right, so now I have balance. So I have at least one debit, at least one credit, different accounts, and it balances now. So you'll get this number, this 156,400 should match the amount that you have as your net income on your income statement. So it's a way to check yourself as you're going through those problems in this particular chapter, because they typically make you prepare the financial statements. You can check it against your net income number. This will always equal your net income number. All right, our second journal entry that is required, our closing journal entry, is to close out our dividends account. So we need to close out the dividends account into retained earnings, because dividends are also a temporary account. We want to show the amount of dividends that we're paying out to our stockholders every single year. So go ahead and put the date in here. All right, our dividends are a contra equity account, so they behave in the opposite way of an equity. So a typical equity account is decreased by a debit and increased by a credit. So the opposite is true for dividends. It is increased by a debit and decreased by a credit. So to close out your dividend account, you need to decrease it with that credit. Okay, so I need to make that 0. So if you want to go ahead and put that in first, it will always be on the second line. Put in what you know. So dividends are going to be decreased by the $20,000 because we want to close it out. All right, so the account you're going to hit as your debit is the retained earnings account, because that is the amount you have paid out to your stockholders. So you have a retained earnings balance. You're going to distribute part of that to your stockholders as a dividend. So that reduces your retained earnings going forward. So to remember, to reduce an equity account, you debit it. So we're going to debit our retained earnings account for the $20,000. Oops, I'm a terrible typer. All right. So those are the two typical types of closing journal entries that you will see in an introductory financial accounting course. Again, the purpose of these is to close out our temporary accounts so that they have 0 balances going into next year, so that we have comparability over years for a particular business, so that we can show, are we earning money that year? Do we have net income? Do we have a net loss? And we can zero down on why. So why are our expenses too high? Our revenues too low? What do we need to do to fix it? So that's the reason why we close out all of our temporary accounts and move them into retained earnings as of the end of the particular year. All right, So that does it for our closing journal entries. You'll typically, again, we'll find this in a typical chapter 4, usually, depending on what textbook you're using. It can vary a little bit. And again, your journal titles will vary a little bit depending on what type of accounting class you have, whether you're looking at corporations or sole proprietorships. But the general concepts are the same. You're closing out those temporary accounts and moving it into your permanent account. So if you have any other videos you'd like to see, comment below, and I will try to make some videos to help with your learning in financial accounting. And if not, I hope this video was informative for you, and you have fun going through these going through your particular course. I will see you all again later.